Welcome to Age Pension, Super and Retirement. I'm your host Yvonne, and as always, this is information only and not personal advice. Today we will be looking at income types and deeming, and welcome back Rebecca.
Thanks, Yvonne. It's good to be here.
Fantastic. As you may know, Rebecca is our Centrelink expert in our Facebook group and has also decided that she's going to be a big part of our podcast, answering lots of questions here. We're going to be a little bit more specific now. We had the first episode, an introduction to Centrelink, and the second one was frequently asked questions about the age pension. So now we will just deep dive into one or two topics. So let's get started. Rebecca, how does income affect someone's age pension?
Okay, so there's two main tests for the age pension. So one is the assets test and the other is the income test. So Centrelink assesses you on both the assets test and the income test and pays you based on the result of whichever one gives you a lower pension result, that's the one they use. So today we're going to talk about the income test. Age pension is, it's means tested and it's not paid at the same rate for everyone. People who have higher income don't need as much age pension, so they get a lower rate of pension. Income over a certain threshold, and the threshold is different for singles and couples, over a certain threshold per fortnight will reduce your age pension from the maximum rate. There's lots of different types of income that Centrelink assess. And it can be different to how we think of income, and it's certainly different to how the ATO thinks about income. You know, in your household budget, you might think about income as all the money that comes into my main transaction account is income. And that you might have income from a job, you might have dividends from shares that come in every 6 months, you might have a term deposit that matures and you're going to get income from that. A super fund that has a pension and you're getting income from that every fortnight or every month. All those things are, money coming into your account, but you also might have, some age pension that you're on that comes into your account. So you might think of, these are all my income sources that I use to fund my lifestyle. But Centrelink doesn't assess it the same way. They do look at work income, income from a small business that you might have or a side hustle. They look at rental income, like from an investment property, or if you rent out your home on Airbnb, there's income from that. But the one particular type of income that Centrelink assesses differently to how the ATO and we might think about it is income from financial assets.
Perfect. Let me just unpack this a little bit. So you have mentioned, thank you, so many different types of income. Are there any other types of income, or is that pretty much it on the list of possible incomes?
I think I covered it. I might have missed some. Centrelink website sort of goes through all the different types of income. Well, there's a couple there. So income from overseas pensions that you might have, and also income from defined benefit pensions. So some people have a superannuation that's different to like the standard thing, and you might get a certain amount per fortnight as a defined benefit from an employer. So that's another type of income that Centrelink counts. So lots of different types, and I might have missed some, but you can check on the Centrelink website to see sort of the full list.
That is terrific, Rebecca. There is, I imagine, countless numbers of different types of income. Are all of the types of income counted for the age pension, Rebecca?
As I said, some of the income, that money coming into our bank account, is not counted for the purposes of age pension. So one thing is that the age pension itself doesn't count as income for age pension. And if your partner is on a Centrelink payment, so maybe they're on job seeker or disability pension or carer payment, that money that your partner gets does not count as income against your pension. So that's one important category that is not included. Another important category that is not included as income is the amount that you draw down from your super. you might have $500,000 in super and you've set it up to pay $1,000 a fortnight from your super fund into your normal bank account. That $1,000 is not counted as income for Centrelink purposes. Because if you think about it, it's not income in the same way that like work income is or bank interest. The $1,000 that you're taking, it's really like it's drawing your own money. It's a drawdown of savings or investments that you have. So the $1,000 that you take per fortnight is not counted by Centrelink as income. And that's a really important one because a lot of people get tripped up on that one and they think, oh, I've got that money in super, but if I start to take it out, Centrelink will penalise me and they'll reduce my pension. So it doesn't work like that. Just like if you have $20,000 in a savings account at the bank, when you move that money, if you move some of that $20,000 into your transaction account, that's not income. It is money coming into your bank account, but it's not income in the way of earning that money. Those are probably the two main categories of income that are not counted by Centrelink. What does Centrelink count in terms of your super? Because they are interested in income from super. Like in the money in a bank account, the $20,000 in the bank account is not income, but the bank pays you interest based on that money in the account. And every month you might get $10 or $30 or whatever, you get some interest. So that is the income, the $30. In your super fund, all that money is invested in different things, and your super fund produces income, which you don't really see. It's a bit hard to see, but in your income statements or your super statements. But as the investments are producing, the balance of your super goes up, and that's what the income is. But for Centrelink purposes, they figured out a long time ago that it would be really tricky to monitor exactly how much income is being produced by money in super or money in the bank or money in shares. It's quite difficult to quantify exactly how much income is being produced. So Centrelink uses an assumed rate of income on all your financial assets. Instead of getting you to report it, they just assume a certain rate. And the rates that they assume are actually quite generous. The current rate is only 2.25% per annum, which is a lot lower than what most people would be getting, even from term deposits in the bank. It's a way of making the calculation much simpler for Centrelink, and it's also a way to encourage people to invest their money at better than that rate, so at better than 2.25% per annum.
That is such a fantastic and thorough response. Thank you so much, Rebecca. Now, I think what you're alluding to is this mysterious term that I will say a lot of people are confused by. They sometimes have heard this word deeming, and I do know that it comes up in our Facebook group. If you could, and I think you've hinted at it about its definition being assumed income, is there anything else you'd like to explain about the concept or how deeming actually is used?
Yeah, so deeming, so Centrelink sort of made this term deeming for what they do. And I think the word has been used so much that people forget what it actually means. So deeming, it is an assumed rate of interest on all your financial assets. When you apply for age pension, you will declare to Centrelink all possible financial assets that you have, all of your bank accounts, all of your shareholdings, your super funds, all the accounts you have in super. You declare absolutely everything to Centrelink. They will add up all of the financial assets. So that's bank accounts, shares, term deposits, super funds. They'll add all those up together, and that is the sum of your financial assets. They also add up all of your non-financial assets. So non-financial assets are things like a car, an investment property, personal effects, a caravan, things that don't produce income. They're in a separate category, but we're talking about financial assets today. So Centrelink adds all those up and it might get to 200,000 or 500,000 or whatever. And then Centrelink uses this simple calculation, the deeming rates. They have a small part, like the first around $62,000 for singles and $103,000 or so for couples. They deem a very low interest rate, only 0.25% per annum. So that's kind of like what they would expect people would have in a bank account, not earning any interest, just having like an emergency fund, a bit of money there that's you're not earning any interest on, but it's just there just in case you need it. So they do allow you to have some money at a very low interest rate. And then all the amounts over that threshold, that deeming threshold, is assumed to earn 2.25% per annum. And Centrelink converts that to a fortnightly rate. So they add it all up to get the total sum of your financial assets. Then they apply their calculation, determine what the annual rate of income is from those financial assets, and then divide it by 26 to get a fortnightly rate. That fortnightly deemed income is what they use to determine your age pension amount. So that's the deemed income. That's one category of income, and that will be added to any other income sources that you have, like we mentioned before, rental income, work income, that kind of thing. So I guess one important thing to mention now is that investment properties are not deemed. They will look at your actual rental income from that property. So if you have an investment property that's worth, say, $600,000, they don't deem it to earn 2.25%. They look at your actual income from it. So for some people, they might be renting it out through a real estate agent and getting $600 a week from it. So that would be the income from that property. You can offset some expenses from that, like real estate expenses and other costs of holding the property, like council rates and stuff like that. Other people might have a property that they're letting a family member live in for rent-free. So you're not actually getting any income from that. So in that case, the income from the property would be zero. You're not getting any income. An investment property does not have deeming applied to it. They look at your actual income from that property.
That's fantastic and such a big topic to unpack. Rebecca, is anything exempt from deeming?
So all financial assets are deemed. So I guess anything that's not a financial asset is not deemed. So like I just talked about, an investment property or like a car or caravan that you have, they are not deemed to earn any income because they don't, just sits there, you just use it.
Excellent. Is there such a thing as an income-free area, Rebecca?
Yeah, so that's the income-free area is a threshold of income that you're allowed to earn from anywhere, from your financial assets, from rental income, from anything that does not reduce your pension. There sort of has to be an income-free area because otherwise there's like no incentive to have your own savings, have your own wealth. There needs to be some kind of incentive to, save for your future, that kind of thing. So there is an income-free area for couples. It's currently $380 combined per fortnight. And for singles, it's $218 per fortnight. These are the rates current as of August 2025. They change on the 1st of July each year. You can earn up to that amount from financial assets from any source, and it doesn't affect your pension. If you have income over that threshold, then it will reduce your pension.
Is there any way of saying how much the income over this income-free area actually affects someone's age pension?
Yeah, for singles, income over the threshold reduces your pension by 50 cents per dollar. Couples, income over the combined threshold reduces each person's pension by 25 cents per dollar. So if only one of you is on a pension, it's 25 cents per dollar. If you are both on a pension, then it's a combined 50 cents per dollar, which is the same as singles, but it's done equally to each pension. So yeah, reduces 25 cents per dollar for each pension.
Great. Thank you so much. And just another reminder, this is always information only and not personal advice. Rebecca, how is irregular or casual income assessed?
So casual income sounds like you're referring to casual work. So if you are working when you're on age pension, you need to report to Centrelink every fortnight how much you have been paid from work. And Centrelink will use that income to add it to your other income sources and to determine your rate of pension. For people who are working on age pension, there is a special thing called the work bonus that helps you to earn extra income from work without it affecting your age pension. There's a problem that the government's trying to solve with the work bonus. So let's say someone's been on age pension for a little while. Let's say they're 68, they've been on age pension for 12 months, been retired and going along, retired, going fine. Well, let's say you get a call from your old boss and they say, hey, we've got someone who's gone on extended sick leave and we need someone to fill in for a little while. Can you help out? Can you work full time for 6 weeks? And then the person might think, well, yeah, I could do that, but why would I when Centrelink's going to reduce my age pension? So as an incentive for people to take up part-time work or seasonal work or casual work or any kind of work, the government has this thing called the work bonus. So the work bonus allows you to offset some of your work income from assessment from Centrelink. Let's imagine that, someone's been on age pension for a year. Their work bonus balance has built up to 11,800. Then that person can start this part-time work or this, season of work. That means they can earn up to that amount, at least that much, $11,800 of income from work. And that won't affect the age pension until you've earned more than 11,800 in total. For that person considering, maybe, will I do this work? Won't I do this work? The work bonus is one way it sort of tips them in favour of, I can do this work, I'll get a bit of extra money. I won't lose any of my age pension until I've been working for a while. So that's one incentive to help encourage pensioners to take up a bit of work.
Could I just ask for a little bit more information regarding the work bonus, please?
Yeah, so the work bonus accumulates $300 each fortnight if you are not reporting work income, and it builds up to a total of 11,800 as a maximum. When you first start on age pension, there's a $4,000 initial balance of work bonus, and then if you're not working, that will accumulate over time, adding $300 each fortnight. It does not reset each financial year, as some people have got this idea that it resets. It does not reset. It just accumulates each fortnight, rolls over from one fortnight to the next if you haven't used it. So here's an example that maybe helps to understand it. Let's say somebody has got $1,000 in their work bonus income balance, like that's their carryover from last fortnight. They've got $1,000 of work bonus credit. And then let's say they do some work and they report $1,500 work income. Now, the first $300 is exempt from assessment because of the $300 work bonus. So that brings the income from $1,500 down to $1,200. And then they've got $1,000 credit in their bank, if you like. So that brings the income from $1,200 down to $200. So there's only $200 of income left over to actually affect the age pension that fortnight. That $200 is added to any other income, assessable income as assessed by Centrelink. So it might be deemed income from financial assets or rental income or an overseas pension or something like that. So that shows you how the initial amount you report of $1,500 is not the amount that Centrelink uses to affect your pension that fortnight.
That is super helpful. Thank you for clarifying there, Rebecca.
Not a problem. The other group that the work bonus helps is people who are 66, approaching their 67th birthday. They're still currently working and they're thinking about, when I turn 67, do I retire and claim the age pension or do I keep working? And, the more people that you have in the workforce, the more taxes you're going to get, the less age pension you're going to pay. So the governments would like people to continue working. They don't want people to give up work just to claim the age pension when they would otherwise be happy working. So the work bonus has a starting balance of $4,000. So for someone who is 66, turning 67, currently working, if they know that their assets are low enough that if they stopped work, they would definitely get age pension, the work bonus actually means that they can apply for age pension coming up to their 67th birthday and can start on age pension from their birthday onwards, even while they're still working. So a starting balance of work bonus of $4,000. So in the first fortnight on age pension, the first fortnight after your birthday, you report your work income, but the first $4,000 of work income is not counted in the income test. So if you're earning $3,000 a fortnight, that's less than $4,000. So you will get a payment of age pension in that first fortnight and the work bonus balance will reduce, but you'll get a payment of age pension and you'll get started on the pension card. And then the next fortnight, you report your income again and your work bonus will be used up and your age pension may reduce. But you've still got that pension card to use. So I see a lot of people in the Facebook group assuming that because they work full time or because they earn more than the income limit that they can see on the website, that they're not going to be eligible for age pension until they stop work. But the work bonus starting balance of $4,000 means that for a lot of people, that's not the case. So even if you earn more than $4,000 a fortnight from work, you might think, oh, well, I earn more than $4,000, so this doesn't apply to me. But because of how the work bonus works, even if you earn more than $4,000 per fortnight from work, you still may be eligible to start on the age pension and get that pension card, get those benefits started, and then you're in the system and you sort of started on that, and it just gives you a bit of extra money, gives you a pension card, and allows you to sort of ease onto the pension and ease into retirement rather than having to give up your work just to claim the pension.
Thank you. That is such an amazing and valuable answer. If I could just ask Rebecca, what happens if someone was to earn too much? Would their pension just be cancelled?
That's another really good question. So on the Centrelink website, you can see the income limits for age pension. One important thing is to note that the limits shown on the website do not include the work bonus. So if you've got a work bonus balance, then you can earn more than what it says on the website. And also, if you get rent assistance with your pension, that adds to the income limit. So you'll get an even higher income limit if you get rent assistance with your age pension. But that said, there will be times when people earn more than the income limit for their age pension. Maybe you've done some overtime, or maybe you've just got a good paying job and you're earning in excess of that income limit. So Centrelink doesn't want to have people cancelling their pension and then, 3 weeks later starting it again because they stopped work. It's much simpler for everyone if you can stay in the system without cancelling and reapplying. So if you earn more than the limit for age pension, Centrelink doesn't cancel you. They just pay you $0 for that fortnight. And then the next fortnight, you're still in the system and you report your income again. And that fortnight, maybe you've earned a bit less from work and you are eligible for some pension. If you are, they'll just pay it to you and then you go on. If you are still earning over the threshold, they will keep paying you nothing in age pension. But it's good to just stay on the system. You can keep using your pension card all of these fortnights when you report your income and you get no pension. You can still use the pension card. So you're still on the system. If it gets to the point where you've had 12 consecutive fortnights of no pension because of your work income, after the 12th fortnight, your pension will suspend. It still won't cancel, which is really helpful. It suspends. So this means that you won't have to report your income anymore. Centrelink is assuming that you are earning enough to not get any pension. So you stop reporting your income, but you can still use that pension card. And the suspension period lasts for 2 years, which means that if in that 2-year period you reduce your hours or you stop work, you have maybe decide to go traveling for 6 months so you're not going to work, you just call up Centrelink and say, hey, I've stopped working or I've reduced my hours. I want to get back on income reporting. I want to see if I can get pension again. And your pension can just be reinstated straight away without having to go through the whole application process again. So this is such a helpful thing. This came in just a couple of years ago. So helpful for administration reasons. It gives people an incentive to do more work if they're feeling capable and if they're enjoying their work. Do more work, get the extra money from it and still use the pension card and know that if things change, then you can just get straight back on the pension with no drama.
Absolutely amazing, Rebecca. You have such an amount of knowledge that you've just passed on to our listeners. This was one extra long episode, I think. So thank you so much for bringing all that to our listeners. Our code word for international listeners wishing to join our Facebook group is RED. And as always, this is information only and never personal advice. Rebecca, thank you so much. I hope you can now unwind after that with a nice cup of coffee because there was a lot there. Thank you.
You're welcome, Yvonne.